What is cash flow? Why is it important for a small business? And how to avoid cash flow problems. Find out why cash flows are essential to a small business and how an entrepreneur or company owner can take proactive ways to track, measure, and increase liquidity levels within the organization. U.S. Small Business Administration researchers have found that more than 3/4 of small business failures are linked to poor cash flow management. If you own a small business or plan on owning one soon, watch this video. Welcome back, folks, to another edition of 𝗬𝗘𝗐𝗦. We're all talking today about a wonderful topic, cash flow. But how you doing? Hope you're doing fantastic. And if you are doing as great as I am, go grab a cup of coffee or tea or vodka and let's roll. Today I want to talk to you again about what is cash flow, why is it important for a small business, and how to avoid cash flow problems. Number one, what is cash flow and why is it important for a small business? Now, cash flow is basically all the different sources of cash coming into your company. Cash flow gives you a good idea if you are in a position to expand, right? Why is it important? Now, cash flow, or what is commonly referred to as working capital, is the heart of the business. If you think about it, it's the lifeblood. Without cash flow, a business cannot survive. Now, a lot of business owners make the mistake of spending without consideration for the future. For example, they might buy excess inventory that ties up cash in inventory versus having it readily available to meet short and long-term obligations of the business. I'll give you an example. We're currently in the midst of a global pandemic. Imagine if a small business had taken all their money or a great portion of the money and invested that in inventory. Now, with the lockdown and a lot of stuff happening in the global economy, that money has been tied into the inventory, and the inventory is sitting in warehouses. And on top of that, they have to pay money on storage. So it's a double loss, right? Now, how does cash flow impact small business loans? Now, cash management is critical when you consider how tight the banks are with small business loans and other money vehicles that can be used when cash runs short, right? Small businesses, they run the risk of losing employees, suppliers, and facing interest and penalties as a result of poor cash management. So you want to make sure that you pay attention to cash flows in your business so you can stay current on cash needs. You can stay current with other liabilities you have in terms of business loans, tax payments, accounts payable, and inventory. So that's really the great way to manage your cash flows in the short run. So you know how much money you have in the system for each period. And you want to compare also your incoming cash with your outgoing cash. So you have a clear idea of whether you have a surplus or a deficit, right? It's a way to balance things. It's a way to strike a nice balance at the operational level to know that you are staying afloat. How do you improve your cash flow? Now, a lot of small business owners, they want to know how to improve their cash flows and keep their business healthy. Now, you can, for instance, instead of buying equipment, it's better to lease. When it comes to real estate, it's also better to lease versus buying. Here, I'm not talking about the larger question of buying versus leasing. I'm just saying, if you want to save on cash, if you want to reduce the amount of cash you spend on things, it's better, for example, to lease a building than buy one. This is one of the best ways to make sure you've got money for day-to-day operations, because leasing, for example, allows you to pay in smaller chunks, which ultimately boosts your cash flows. How do credit checks help? Let's say your customers pay you in cash. If they do, then you don't have any problem. But if the customer pay you, let's say within 30 days, or they pay you with credit, I mean, you have to give them credit 30 days or 2 weeks or 3 weeks, then you want to double check their credits. Every small business needs to make sure that even if you want to have that extra sale, you need to make sure that the customer, the prospective customer, is credit worthy, because there's nothing worse than having a late payment take a dent into out of your cash flow, out of your budget. Of course, you made the sale, but you never got the revenue. And remember, there is an accounting term called allowance for doubtful accounts. Let me repeat that. There is a term called allowance for doubtful accounts, which means that you made the sale, but the sale didn't pan out. The sale didn't translate into income, into revenue, into cash. So you made the sale, but you had to write it off. You had to write off the sale because the account has become a doubtful account, meaning the person, the customer is not able to pay. Now, why are down payments important? When it comes to some capital purchases, let's say real estate, let's say equipment, for example, if you are in a good cash position, if you're able to manage your cash flows properly, you can make that down payment. Now, if when it comes to real estate, for example, if you don't pay the 10% or 20% down payment, if you're not able to afford that, you pay something called private property insurance. I don't have the right word. I think it's PMI. Yeah, PMI. It's the private mortgage insurance, and you have to pay that over the life of the mortgage. And that's if you are paying less than the down payment. So having a good cash flow position, being able to manage your cash flows at the business level has many, many, many perks. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. We are having a conversation today around cash flows for business. Why is it important for a small business and how to avoid cash flow problems? Let's talk now about how to calculate cash flow and prepare a cash flow statement. If you love the clarity of and the quality of the content so far, please consider subscribing to our channel. You can turn on the notification bell. We do this kind of shows every single day. Rain or shine. We have a variety of topics, not just the finance and cash flows. We cover everything from entertainment to traveling, and we just love we love the diversity of topics for our team. It's encouraging. It's very stimulating intellectually to look for items, to look for topics and research them. So if you love the variety of shows that we give you, please consider subscribing to our channel. You can also check our playlist. We have 30 different playlists, and you can find out what really interests you and delve into that. Like this content, share it, and comment if you find it interesting. Now, what is a cash flow statement? A cash flow statement basically is a recap of where the money is going in your business and whether you're making a profit or suffering a loss, right? So it is important to understand that you need to calculate what qualifies as cash flows. Now, in the United States, there is something called U.S. GAAP. So U.S. generally accepted accounting principles. Now, those principles govern how small businesses and large businesses, for that matter, should prepare a cash flow statement. Now, a cash flow statement has three categories, has three parts. You have cash flow from operations, cash flow from investment activities, and cash flow from financial activities. Now, it can be from, or it can be used by, or provided by. It really depends. So let me repeat that. A cash flow statement has three categories. So you have cash flows from operational activities, cash flows from investing activities, and cash flows from financing activities. Now let's talk about operational activities. If you hear the words operating activities or operational activities, is the same thing. So operating activities include things like payments to suppliers, receipts from customers, insurance, anything that qualifies, anything that is any expense or revenue item that is part of the business core operations will be lumped into the cash flows of operating activities. Now, if the business has a surplus, the wording is cash flows provided by operating activities. If there is a deficit at that level, you have the mention cash flows used by operating activities. Let's talk now about cash flow of investment activities. What are investment activities? Investment activities are everything that you see on the balance sheet of a company. The balance sheet is it's also called a statement of financial position or statement of financial condition, and that's the statement that indicates everything from assets to liabilities and to the owner's equity. Now, investment activities are activities that relate to the long-term or capital assets of a business. So this could be equipment. So if a business acquires equipment, this will be part of the investment activities. Why? Because the equipment is considered an investment because it will be useful to the company for a period greater than 12 months. That's the criterion that accountants will use to determine whether or not an item qualifies as a short-term item, as a short-term capital asset, as a short-term asset, or a long-term asset. And long-term asset, sometimes this is called a capital asset. So if an item will serve in the business operations for a period less than 12 months, let's say office supplies, for example, you can't capitalize that. You can't transform it as a long-term asset. It is a short-term asset. So when you buy those, you don't treat the expenses as investment activities. You treat those expenses as operational activities. Conversely, if you buy a long-term asset, you buy equipment, you buy a car, you buy land, you buy a machine, you buy whatever asset that will qualify, that would be useful rather to the business for a period exceeding 1 year, then this asset, which becomes a capital asset or a long-term asset, will be the purchase of that item will be included in the investment activities. Likewise, if you sell equipment or machinery, this will be an incoming cash flows. It will be a cash inflow in the investment activities. As I said earlier, if you have a surplus, then you say cash flows provided by investment activities. And if you have a deficit, you have cash flows used by investment activities. Another category of investment that I need to mention here, this is financial markets. So if you buy stocks or bonds and you intend to hold those for a long period of time, then you can qualify that as an investment when you sell it. Now remember though that you cannot mention unrealized capital gains, unrealized gains on those investments in the cash flow statement, because you haven't sold the stocks or bonds or ETFs or whatever assets you bought. Unless you sell those, you cannot use them in the cash flow of investment activities. The third category here is the cash flow of financial activities or financing activities. Now, financing activities relates to anything that help the company raise funds. So that is the issuance of shares, the issuance of equity shares, or the application, a loan application. So if the company gets money from a bank as a loan or from shareholders as equity, those activities will go in that category. Similarly, if the company buys back what we call stock repurchases, stock buybacks, that will also go into the cash flow or financial activities. If a company issues dividends, pays dividends, that's a minus in the cash flow of financial activities. So what I'm trying to say here is that a statement of cash flows has three categories: operational activities, investment activities, and financing activities. For each category, you need to add whatever qualifies as inflows, money coming in, and you need to subtract whatever qualifies as outflows, money going out. So for each category, you need to have either a surplus or a deficit. So once you do this for each of the three categories, you need to add them up. You need to add up the cash flows from operating activities to the cash flows from investing activities to the cash flows from financing activities, and the total, the grand total, will be the cash flow for the period. Usually you can do this for a month, a quarter, 6 months, or a year. All right? I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. We're actually having a conversation today about what is cash flow, why it is important for a small business, and how to avoid cash flow problems. Now, I've spoken to you about how to calculate a cash flow statement and how to calculate cash flows in general. I also spoke to you about what is cash flow, what is the conceptual element in cash flow, and why it is important for small business. Now, let's talk about how to avoid cash flow problems. This is an important one. There are several ways, and we're just going to go to the most important ones here. Always do appropriate planning, and you want to do this all the time. If you want to avoid a cash flow crisis, you have to plan. You as a business owner or manager, you must look at the profit and loss and other non-operational items or circumstances that specifically affect the cash flow. For example, if you are in the red, if your P&L is negative, in other words, if you're having a loss, that's a big no-no already. Or if the profit margin is in single digits, you're making maybe 3% or 2% or 1% or 0%, 0.5%, then you know we're not really close, we're not really far from a loss. So you want to start paying attention. You also want to take proper steps to manage profit and loss. Now, a profit and loss, which is another statement I spoke in this show about, the statement of cash flows. There is another statement called the statement of income or income statement, also called P&L or profit and loss. The thing is that the P&L is linked. There is some kind of harmony, some accounting harmony between the P&L and the cash flow statements. Why? Because the P&L has two main categories: revenue and expenses. Right? And if you think about the statement of cash flows, as I said earlier, you have three categories, but you have money coming in and money going out. And if you think about it, revenue constitute a source of inflow, of cash inflow, money coming in, and expenses constitute a source of cash outflows. So you can avoid cash flow problems by managing the profit and loss, by seeing the level of revenue as well as the level of expenses, right? So that's the second thing you can do. You can also create a forecast for future cash streams. This is great because if you're able to create a forecast of future cash, if you can do this preferably on a weekly basis, for example, you'll be able to catch very early any potential problems. Because if you develop an understanding about when revenues can be collected and when expenses can be paid, this is a comprehensive and effective cash flow strategy. If you do this over the next 52 weeks, you're able to, of course, you can't predict everything in the business, but you're able to work on from a baseline. You're able to identify the issues that might cripple your business from the liquidity standpoint. Another way to avoid cash flow problems is to think about the timing of all operational cash payments. Operational cash payments is a keyword here. Cash payments. Now, cash payments cover everything from expenditures, so payroll, accounts payable, income taxes, insurance, and so on and so forth. You also have loan payments, that kind of stuff. But you need to think about the timing here. It's not about the amount all the time. It's also about the timing, because there is a gap between, there is a mismatch, if you will, between when your customers pay you and when you have to pay your suppliers and other service providers. If you are in a business where you have to give your customers a credit of 30 days, you give them a timeline of 30 days to repay you, and there is a mismatch in terms of you receive money from your customers 30 days after shipping the products, while you have to pay your suppliers within 15 days. There is a mismatch there. So you always run into problems here. So you need to determine the proper timing of all operational cash disbursements. Another thing you have to understand here is that when we talk about cash disbursements, you also have to think about things like dividends. If your business is owned by shareholders, then you have to plan dividends. If you own your business, then you also have to think about draws, owner draws. You need to pay yourself unless you have other sources of revenue. Okay. You also want to do some kind of comparative analysis. What I'm trying to say here is that you want to compare actual results versus forecast. Every small business must do forecasting. This is critical. This is a big yes. You have to. I don't care how small your business is. If you don't forecast, if you don't plan, if you don't anticipate the future, if you don't anticipate business conditions, you are going to be lethargic. You're not going to grow. So you need to forecast. And forecasting allows you to carry a comparative analysis between actual results and the forecast. And if you have a negative or positive variance, then you know I'm doing the right thing or the bad thing, right? So for instance, if you have a negative variance, it means, for instance, that you plan to get a sales of, say, 1 million and you got 800,000. That's a negative variance here because you have a 200,000 deficit from the actual result versus the forecast. And if you keep having that deficit year over year after year after year, you have to start thinking, okay, this could lead me to having liquidity problems, cash flow problems, right? So remember though, no forecast is perfect. You can always come back and adjust any item that looked to be incorrect. I'm not saying a forecast should be set in stone. It's just a starting tool. It's a tool that allows you to start doing some kind of analysis. You want to start with what information you currently have, and you can refine the process over time, but you have to start. You need to have something. I don't care if you have it in Excel, it's fine, right? You don't have to buy software for that. You can use Excel. This is perfect, but you got to have something. Another thing you need to do is you want to think about the operating expenses. You want to scrutinize them, because we've all talked about doing forecasting, doing proactive planning, trying to understand what's really happening in terms of accounts receivable, accounts payable, that kind of stuff. But you need to scrutinize certain operational expenses. And the best way to do this is to go to Excel. You have an Excel spreadsheet where you put, very simply, all the categories of expenses. I'm talking payroll, utilities, the big expenses, materials, cost of goods sold, insurance, and so on and so forth. And what you want to do is you want to calculate those expenses as a percentage of the total expenses. That way you know which expense is the biggest. Let me give you an example. Let's say you have in your business total expenses for this year is 100,000. And when you go into the analysis, you realize that payroll accounted for 50,000. So payroll accounts for 50% of total expenses, and utilities accounts for 12%, and so on and so forth. And insurance accounts for 7%, right? So you are looking at expenses not as the dollar amount, but you're looking at it at the percentage amount. So what you can see is that you can analyze this from period to period and see if some expense category is growing over time or shrinking, and you can take action. Another way to also avoid cash flow problems is to avoid filing delays in deposits of payroll or other taxes, right? Because the penalties can be very severe. I mean, if you pay the IRS late or you pay the state tax authorities with the delay, all those expenses, all those penalties, they add up, and that's a dangerous, slippery slope. You don't want to get on it, right? So this is basically it. I wanted you to comment below if you are a small business owner who has successfully overcome cash flow problems, or you're currently having cash flow problems. Please share your experience in the comment section. Tell us how you ran into, how you avoided, how you overcame issues related to small business liquidity. All right. So to kind of recap today's conversation, I spoke about what a cash flow is and why it is important for a small business. I also showed you how to calculate cash flow and prepare a cash flow statement. And finally, how to avoid cash flow problems. I will see you next time. But until then, remember, stay marvelous.